Hey there, everyone. Welcome back. You are watching Insight. Right now, we are joined by Heather Foster with Foster Financial. You guys, we're talking about continued volatility and interest rates. We're always being able to get those tips from Heather Foster. Heather, today we have you here virtually with us, but that's not stopping you from bringing us those tips. Talk to us about our topic for today.
You know, I think everyone knows that October is typically a pretty volatile month. But maybe we have some extra volatility just due to the outside circumstances. So I wanted to talk a little bit about the volatility that we're experiencing right now, as well as interest rates. So there was a conversation I started having with my clients, Tony, several months ago, actually, when we had a really nice rebound in the market. I mean, the markets came really close back to what they were prior to last year's drop. And then the question and the conversation became, do you want to continue with volatility? Because the trade-off to those fixed interest rates, because interest rates have gotten so high, maybe you want to start to reduce some risk. Really, that conversation has not been able to be had for a very long time because the trade-off of risk and into interest rates, you had to basically earn nothing. So you were saying, hey, let me trade out of the risk side that's been averaging, 10 and 12 and 15% for something that's more stable, but maybe they're only earning 1%. With the shift in the interest rate environment, now we're seeing 2 and 3 year fixed rate products above 6%. We just had a new one come down the pike, Tony, at 6.15% for a 2-year or a 5-year product. We're seeing municipal bonds after you take into account the effective rate and not having to pay federal taxes, yielding over 6%. When you're seeing all these numbers come in at 6%, and the market is still volatile, people are questioning, is that risk still worth that reward? And this is going to be a conversation I feel like we're going to continue to have going into next year as well. So is the risk still worth the reward? There's a lot of question and concern around this. If we're going to be in volatile states coming into this fall, which was anticipated, most economists are suggesting that we may see quite a bit of volatility going into this last quarter of 2023 and into 2024. Do you want to still be a part of the risk side of the market? Do you want to trade that off now for something that's guaranteeing you over 6%? And that's really perking people's ears up. So the thing about it is, Tony, I want to mention something.
Yeah.
When I've mentioned this to several of my clients, I think they're really comfortable with how we manage risk in our office because we're active financial managers. We actually already are doing things to mitigate risk. But when I actually have that conversation, do you want to trade any of your equity positions for those conservative positions like a fixed rate product? The answer has been no. And so the only thing that concerns me is people who call when the markets are down, on the other hand. So people call when the markets are down, they're saying, hey, the markets are going down, I want out. You guys have to remember out there that when's the best time to sell? When the markets are high.
Yeah.
The best time to buy, right, is when the markets are down. So I've been having this conversation coming into 2023 with all that rebounding about June, July, started having conversations saying, hey, this is the time. If you're going to trade equities for safer positions, the timing is right to do that because the exchange is at a close to a market high, and we're exchanging it for a good interest rate. My fear becomes for those emotional investors out there, you wait through this quarter or maybe the next quarter and the markets go down, and then you want to trade out of the equity markets and go into those fixed rate products. Yeah. It's not that trade-off still won't make some sense particularly, but you want to make sure no one can truly time the market. But it's the timing is if you're close back to market highs and exchanging that for a fixed rate product, the timing may have been right a few months ago. It still may be right because we haven't had too much volatility. But again, historically, October is typically a bad month. And according to the economists, we're probably heading into a mild recession.
You know, that having that risk versus that reward and really being able to ask those questions. And like you said, you guys are those active agents. You guys are those active financial advisors and always kind of looking and monitoring. So look, Heather, we appreciate those tips as people begin to get ready for 2024 and saying, look, what am I going to do? Do I want to do this? Do I want to do that? That's why it's important for people to get in for that complimentary consultation to see if this is something that's right for them, right?
Absolutely. It is important that people take their money and their risk and what they're exchanging that risk and reward for into their own hands.
That's right. Thank you so much, Heather Foster, as always, for those great financial tips. Everyone, take a look at your screen right now. You see more information about Foster Financial. Go ahead and give them a call. Visit that website. We'll be right back.